Hello, everyone. I'm Ted Oakley, managing partner at Oxbow, and I have always great guests and my friend Jim Bianco, president of Bianco Research. But Jim, I want to welcome you today.
Thanks for having me. Look forward to the conversation.
I have to brag on you a little bit because 5 years ago, almost to the day, bond yields hit their low or close to it. I may be off a month or something, but I remember distinctly when you came out and said, this game's over. And a lot of people think, oh, this guy, whatever. Anyway, you're right on the money, and you've been right on the money uh, with bonds, talking of the bonds and where they wouldn't come back to the new lows and that sort of thing over the last 2 or 3 years. So I just want to commend you on that. But I'm going to start out, we'll get to there, I think, probably, but I want to start out by you have a great take on the pros and cons and the outcomes of what's going on in the tariff situation. So I thought you might share that with us.
Yeah, I think, what people need to understand about tariffs is they're a process or a means to an end. And what is the end? Let's start with the fact that the United States has almost 100% debt to GDP, $36 trillion of debt, a roughly the same size economy. That is clearly unsustainable. Chairman Powell has said it's unsustainable. Scott Bessent, when he was not the Treasury Secretary last year, said it was unsustainable. People like Ray Dalio, Mohammed El-Arian have said that it is unsustainable. So we need to change that. And we need to change that in a hurry. And so the Trump administration is proposing some radical policies headed by tariffs, security payments, maybe from Europe, maybe a sovereign wealth fund, and the like, to try and reorient what we're doing, realign the financial system of the monetary order. Now, maybe they're doing it wrong, or maybe they're doing it right. Maybe this is part of the negotiating play, remains to be seen. But what I've really pushed back against is this idea that people are like, he's ruining everything with tariffs. All right, I'm not going to suggest that the process that they're doing is right, but the implication there is just stop. Let's just go back to last year, $2 trillion deficits. Let's lift the debt ceiling so we could go to $40 trillion of debt and just continue to have the government be a third of the US economy, which is one of the highest it's ever been, not in a war or a crisis like COVID. That we can't do. So what I've argued is if you don't like the policy, then give me another radical policy we should be doing. But we can't go back to last year's status quo. I think we're moving forward from here, and we have to start to think about it in those terms.
In other words, what you're saying, if I hear you right, is we have to do something. And if you go back, it's disaster.
Yeah, I think it would be. I actually have argued that if you wind up going back, if Trump were to wake up today and say, you know what, I changed my mind, we're off with tariffs, don't worry, Europe, we got your back on security, we'll spend whatever we need to do to take care of that problem. And all the way down the line, I actually think the bond market might take it worse because the bond market would say, that means we're going to have a 10-year auction every other day in order to meet the tremendous financing need that we would have coming forward and swamp the market with so much debt. Remember, in the bond market, there's an old saying, there are no bad bonds, there's only bad prices. If we need to issue and issue and issue more and more supply, it will get issued and people will buy it. We'll just take the prices down and take the yields up enough that will suck money out of everything else to get the bond market funded. And that's what we absolutely do not want to have happen. And so that's why I think that if we went back to the status quo, it might not be the fix that everybody thinks it is. So, and the other thing I should mention too is there are real issues. The current trading system with the tariffs that we have and everything was set up after World War II, when we were the only industrial power left. Everybody was destroyed after the war. On average, we pay 4 times the tariff, or Europe charges 4 times the tariffs that we charge on products coming into our country. Well, up until the time that the Berlin Wall fell and the Soviet Union ceases to exist, that was an arrangement, if you want to call it, be blunt, a bribe to get everybody to side with us, not side with the Soviet Union. And that was 35 years ago that the wall fell. The world has changed now. That system needs to change. And so I don't think there's a lot of controversy in the idea that we need to change that system. The controversy is, are we doing it the right way?
Well, and I think if I remember correctly in your writing, you have two reasons for doing it. One of them is not so great, and one of them may be okay. But did I understand you correctly?
Yes. So the idea with tariffs, which is why I personally, until Liberation Day, wasn't that exercised about it, was there's two arguments you could use with tariffs. One is there a club or leverage in order to say, I need another country to do something. And hopefully the goal is to open up trade, make trade more accessible, and even out the playing field. And I'm going to use this club of tariffs in order to get you to that goal. No problem. No problem with that at all, because the end goal is something I think is what we all want. If the other side of the equation is I want to use it for revenue, and let's call a tariff what it is. It's a tax increase. It's a tax increase at the border, and it's a major tax increase. So if you want to use it as a major tax increase, then we run into all kind of problems. I think what happened on April 2nd, Liberation Day, is a lot of people thought like me. He was thinking tariffs were going to be leverage, were going to be a club in order to achieve a goal. But when he brought out that big list and started listing off the countries and the tariffs that they were going to start to pay, it sounded like we're about to get a massive unexpected tax increase that really threw everybody and changed our outlook of what he thought the purpose of tariffs were. And so, yes, tariffs can be a useful item depending on what your goal is. And to be honest with you, at this point, I thought his goal was leverage. Then it looked like his goal was going to be tax increases. Now we're back to that murky middle again. I'm not sure what the goal is right now.
Yeah, and it's interesting, Jim. People buying this market the last couple of days act as though there's no tariffs, that nothing's happening. But if you go, I think you would agree, if you go back and look at the numbers, we have tremendous tariffs even now relative to what it would have been, before.
When the market got excited that, Trump put a 90-day reprieve on tariffs back on April 9th, and even earlier in the week we're recording when he talked about backing off some of the auto tariffs and the market celebrated that. The thing that everybody forgot was he's not backing off on the tariffs on China. Now he's kind of made some noise in the last days before we talked that maybe possibly, but he's kind of contradicted himself. And if you don't back off of the tariffs on China, you've really not lowered the overall tariff rate in the United States. Tax Foundation has done this estimate that the tariff rate in the United States was 2.4%. So everybody understands what we're talking about. When a product comes in from overseas, we put a 2.4% tax on average, some more, some less, some none, some more. And we put a 2.4% tax on it in order to bring it in the United States. Bloomberg is now estimating that number is going to go from 2.4% to 22%, a 10x increase. And it would be the highest tariff rate that we've seen in over a century and the biggest one-year increase ever. And so that's really when people talk about they're celebrating that tariffs have been relieved. If you don't take them off of China, you're going to be stuck still with a 22% tariff rate.
So let me ask you this, and I'll switch to inflation, and you've been really right on inflation. You said over the last few years that it would be a higher level. We would maintain a higher level, which we have. We never went back to that in most people's opinion. Do you still feel that way, that inflation will still come in at higher levels generally over the next 5 years?
Yeah, I think that, the way I've liked to explain it to people is every time you have a financial crisis or recession, and we had both in 2020, remember the stock market did fall 35% in a month, you change the economy. Now, I like to be very clear, change is not dystopian, it's not worse. We didn't make the economy worse, we made it a little bit different. And if you wanted, the example that I always use is remote work. Prior to COVID, about 4 or 5% of the workforce was working remotely. Today, it's about 26 to 28% of the workforce is working remotely. That changes your lifestyle, that changes the things that you purchase, that changes your tastes and your preferences. That has put the economy a little bit out of balance. The result of that has been higher levels of inflation, 3 to 4% higher levels of inflation. Not, as I like to quip, 8, 10, or Zimbabwe levels of inflation. We're not going to get anything like that. The normal, basis run rate. Now, why is the difference between 2% and 3 to 3.5 matter? because interest rates matter. What a 3% inflation rate would suggest, all things being equal, is that the federal funds neutral rate, where the Fed would stop raising rates, is somewhere around 4 to 4.5, which is exactly where we are now. And the neutral rate for the 10-year yield might start with a number 5, not the number 4. We're currently, as we're talking, 10-year yields are around 4.3%. They might go to 5. Now, as I try to argue, because of the higher inflation rates, those are the neutral or the fair value for interest rates. What I've noticed that a lot of times when I go around talking to people and say, yeah, I think that the 10-year yield could go to 5, there's a gasp. Oh my God, what's that going to do to the economy? What's it going to do to housing? Well, if it's fair value, it's not going to do a lot, if anything. If you're gasping because you think that the fair value of interest rates is far lower, like they should be 3 as opposed to 4, then you're suggesting you're overvalued. Well, the way you get to 3 is you have to make the case that inflation has returned to a pre-COVID level of under 2, which it has not. It has not shown any signs of doing that. It is still in the high 2s to low 3s, depending on the measure, and it seems to have bottomed in the last year or so. And the last thing I'll mention about tariffs, which is what's got the Federal Reserve on hold right now, is everybody's worried that we're going to see a massive spike in prices, or we're going to see empty shelves because the supply chain, especially from China, is going to get disrupted, and we're going to have another bout of inflation, tariff-driven inflation, like we saw the bout of supply chain-driven inflation in 2022.
Well, and also, if you think about it, I think you'd agree with me. If you look back over the last 40 years, there was a time when a 5% 10-year was okay.
Not only was it okay, if you go back and you look at the rates between 1982, with the big stock market bottom in August 82, to the financial crisis in 2008, the 10-year yield averaged around 6%.
Yeah.
Now, I'm old enough, and you're old enough, Ted. There was a lot of economic activity, and there were bull markets, and there were businesses that were being created. We created the internet. We created the whole first tech wave, and companies were making profits. Interest rates at that level were not necessarily punishing. Now, the one thing to keep in mind about interest rates, too, is if you look at the Fed's survey of consumer finances, and you say, okay, rates go up, it actually is a net benefit to the public when rates go up, because more people receive interest income because they have money market funds and bond funds and everything that will throw off higher levels of income than have to pay out in the form of higher mortgages or higher loans. And so it's a net positive when rates go up. Now, that is at the top line. When you drill down on that, it's the very wealthy that tend to own a lot of assets like bonds and money market funds and other kind of investments that are tied to fixed income that make that extra income when interest rates go up. And it tends to be the more marginalized and the companies that are not able to self-fund, that have to borrow, and they have to pay the higher rates. So it's unequal in the distribution after you get to the top line, below the top line. But at the top line, it's not a net negative for the economy if interest rates go up. When it becomes a net negative is if you make the case, I make the case that the fair value is around 5. Maybe I'm wrong on that. Maybe it is 3, but let me go with 5 for a second. If rates go to 6 or 7, then it can become a net negative because then they're beyond their fair value and then they become a net punishment. But if they're just going to drift up to their fair value, I don't think it is a problem for the economy. Like you're right, like we saw from 1982 to 2008.
Well, and speaking about the economy, in looking at the last, I guess the last month or so, or last few weeks anyway, it seems as though you've taken a little bit different approach on where the economy might be headed. I think you use the terminology 50-50.
Right.
You still feel that way?
Yes. So what's happening with the economy, and the way that Wall Street likes to describe this is most economic data can be broken down into 2 broad categories, what's called hard data and soft data. Hard data is what most people are familiar with. It's how many cars did we sell in a month? How many billions of dollars of sales were there at all the stores? It's counting up actual economic activity. That data, the hard data through today, and the day we're recording, April 24th, we got the initial claims numbers for April 18th. There was no real massive spike in that, suggesting that the labor market is starting to see layoffs or a lack of hiring, at least not yet. Hard data says the economy is okay. But a lot of the data is what's called soft data. That's survey data. We ask people their opinions. We ask certain types of people, consumers, we ask them their opinion, purchasing managers, we ask them their opinion, CEOs, CFOs. We do lots of surveys of the economy. That data is falling off a cliff because everybody's afraid of the implications of tariffs coming. So, as I wrote this morning, the economy on April 24th is okay. The fear is, where's it going to be on July 24th, 90 days from today? And nobody knows, but the pit in their stomach says not good, because these tariffs are going to kick in and it's going to cause a massive spike in prices, slowing down in the economy, layoffs, and all of this other stuff. Completely understand that. And it could very well be correct. But here's the rub. In this post-COVID economy, the economy changes after a recession. Things don't quite play out the way you think. 2 years ago, March of 23, 25 months ago to be more exact, Silicon Valley Bank failed, Signature Bank failed, Credit Suisse failed, and the stock market fell more than 10%, and everybody's hair was on fire. That's it. We're going to have a financial crisis. We're going to have one. We're just arguing about what kind we're going to have. Does anybody remember the financial crisis of 2023? No, because we didn't have one. It did not unfold the way we thought. So I'm not saying that this one is going to be, completely wrong. It's just we have to be careful when we make these abject statements. We're going to have this happen or that happen because of tariffs. The way I've used the metaphor is the hard data is I'm driving on the car, and we're on the car, and we're driving down the highway, and you keep telling me the soft data, there's a wall, we're going to hit this wall, and we're all braced for impact. Somebody says, there's no wall out there yet. Well, don't worry, that wall is coming. Okay, I get that metaphor, and that wall is the impact of tariffs. But if I was to put a nuance on that metaphor, sticking with that metaphor, what angle are we going to hit that wall at? Are we going to hit it perpendicularly? That would be a disaster. Or are we going to just hit it at a very shallow angle and glance off of it? It will be painful, but we'll survive. That's really what we have to figure out in the next 90 days. What is that hit to tariffs? And what I'm trying to argue to everybody is we have this expectation that it's going to be that perpendicular hit. People are going to lose their jobs, prices are going to spike, and yes, it could be that. But maybe it's not going to be that, it's going to be something a little bit different. That's why I've put the probabilities of a recession at 50-50, because I don't know what the impact is going to be of us hitting that wall. But in 90 days, I suspect I'm either going to be at 90% chance of recession or back at 15 or 20% chance of a recession, because we'll have a better understanding of what's going on.
Speaking about data, Jim, over the last 3 weeks, I've talked to a lot of private businesses, big businesses and mom and pop businesses, every time I get a chance. And sort of the overriding theme with those people is we're just frozen right now. We're not doing anything. We're not doing capital expenditures. We're not hiring. We may have laid off a couple, and we're just stuck. We're frozen. And that has to show up in the economy, I think, eventually.
It will. It will show up in the economy. But the thing about them being frozen is it's analogous to, I know you're down in Texas, but it's analogous to in the north, when you have a snowstorm in January. Everything stops because there's a lot of snow on the ground, but then it restarts very fast. So the good news about everybody's frozen, they don't know what to do. I get it. And it will show up in the data. And that's like when I'm talking about the angle of the wall. How does it impact the economy? But if the perception comes, oh, this isn't going to be as disastrous as we think, we could restart like that. Just like we restart after the streets are plowed with a snowstorm in the north. Businesses reopen and within a day, they're back to normal. Now, maybe it doesn't take a day, but it will be very, very quickly if that's all we're doing is we're just frozen and we're waiting and we're trying to see. Like I said, the analogy, it's like, I'm waiting for the plow to come to plow the street so I can open my front door and have my customers come back into the store.
Well, I might switch to and ask you a couple of things about bonds, because for everybody out there, and we'll put this on there, but Jim, has an exchange traded fund that you manage. I can't remember the exact name of it. I know the symbol, but I can't remember the name.
Yeah.
But what you
So,
might tell everybody.
yes, it's the Wisdom Tree Bianco Fund. Its symbol is Wisdom Tree is my partner in this endeavor, and its symbol is WTBN is what it is. It's a total return fixed income fund. So it's meant for people that are looking for alternatives in the fixed income market. How do I invest in the bond market? This is an alternative that we're offering with our ETF.
And I'm not for compliance purposes and not asking you what you think about the fund exactly, even though I know you're positive on it. But I would ask you this: do you think the average investor can ever own longer term bonds again?
I think they can. That longer term bonds can offer that, a very good opportunity. Now, to be very honest with you, because of my inflation call, I am very cautious on long term bonds right now. But at some point, when there's a high enough yield, they will become a very attractive investment. And then if the inflation rate were to subside, look, I think we've got elevated inflation, but I would also tell you, I think it started in 2021, and I think it'll be over with by 2030. So to put it in a baseball metaphor, we're in the fourth or fifth inning of this inflation thing. So we're halfway through it right now. And then I think that long-term bonds will become a very good investment, because the beautiful thing about long-term bonds is if you could pick up a 10-year yield or something like that. A 30-year yield, I would more suggest if you were a speculator, but if you're an investor, more like a 10-year yield at a 5.5% yield. And then the inflation rate were to subside over the next couple of years and yields were to fall to 3%, you could wind up with an 8 or 10% return on that kind of investment. Now, we're not there yet, but I could see in the next year or two that we can be at that type of environment. And so they can offer those types of opportunities for investors.
Well, Jim, I might ask you a couple of things on the stocks because I know you've had a theory, and most people, maybe if they're watching, don't know this, but you've had a theory about the 456 theory of if somebody's looking at total investments. And you might talk about that a little bit. It's very interesting to me.
Yeah, so I think over the next several years, not necessarily 2025, but over the next several years, cash will return 4%, bonds will return 5%, stocks will return 6. Cash return 4%. If the inflation rate is going to stay at 3, as I mentioned earlier, and that would put the Fed's neutral rate where they stop raising rates would be around 4, which is effectively where they are now. So that means that T-bills and money market funds should return you 4%. The average yield, Bloomberg has a measure called the Bloomberg Aggregate Index. It's what is the average yield of all treasuries, corporates, mortgages, agencies, investment grade bonds. It's 4.9% as of a couple of days ago. So let's round that to call it 5. So over the next couple of years, if you buy a broad basket of bonds, you will get a 5% return. Now, if it's 2023 and there's a rally in the bond market, you might get closer to an 8% or 9% return. If it's 2024 and there's a sell-off in the bond market and yields go up, you might get closer to a 2 or 3% return, but you'll average 5 over that period. So 4 for cash, 5 for bonds, 6 for stocks. Where's the 6 for stocks come from? If you look at the valuations in the stock market, they're very high. I like to look at the Shiller CAPE ratio. That's Bob Shiller, Yale University. His cyclically adjusted PE ratio is 37. 37, he's got data on this going back 150 years. It's the third highest it's ever been, other than 2021 and 1999. Now, it's higher than 1929, but don't be afraid that that means we're going to have a stock market crash. We don't have to necessarily have a stock market crash. What it suggests, though, is that over the next decade, in order to bring valuations back into line. Now, look, we might have a bad year in there. We might have a very good year in there. But over the next decade, you should expect the the stock market to yield or return you maybe 1 to 2% more than the bond market. So if the bond market's at 5, stocks are somewhere at around 6, maybe 7. So let me restate what I just said. In this environment, cash can give you 2/3 of what the stock market index level is going to give you, but a $1 NAV every day if you're in a money market fund. So no price risk. Bonds will return you a little bit more, maybe 75% of what the stock market is going to return you with a little bit more risk. Stocks might give you a little bit more, but you're going to have to take a little bit of a thrill ride like we're seeing this year with them in order to get that. Now, the last thing I'll mention about that 6% is if you're thinking about better returns than that, that opportunity is going to open. In 2023, the S&P returned 22%. 2024, it returned 25%. And I've used the sailing metaphor. I'm not a sailor, so forgive me for all the sailors if I get it wrong. But if you put me in a boat with a 25 knot wind, 25% return, all I got to do is pull the sail up in the air and my boat's going forward. I don't need to be particularly nuanced in what I'm doing. But if you tell me that that wind is going to go down to 6 knots, a 6% return, just getting my sail up in the air is not going to be enough. I'm going to have to be nuanced. I'm going to have to learn how to tack and trim and do all those things that professional sailors do to get the boat to move forward. In 2024, I had a number of equity managers that would talk to me about the virtues of small cap or value or growth or financials or healthcare. And the broad market opinion was, who cares? The stock market's going up 25%. Just own the broad index. Well, if it's going to go up 6%, now those conversations, value, growth, Europe, US, big, small, energy, financials, on and on and on, become important. And there will be themes and ideas within that that you can do a lot better so that we could start thinking in those terms and not just thinking about stock market up or stock market down because of these big returns that we've seen over the last couple of years.
Now, let me ask you a question on that. And I've never spoken to you about this, but if you look at that 4, 5, 6, and a lot of people today over 55 and a lot of people over 70 have a really high percentage of those assets in stocks. And you'd think if you were over 70 and you're within a point, let's say, between a bond portfolio and a stock portfolio, that you would think about reallocating that a bit. Wouldn't you think they would think that? I know they may not do that, but I mean, right. I'm just saying for people in that age group, and they're very, very high in stocks right now. And that I'm just curious what you think about that.
Well, two things about that. I've always called a stock bear market time, not price, right? The stock market for the moment is peaked back on February 19th. So we're 2 months after the peak. Will the stock market make a new high? Someday it will. And the question is, how long will it take? Will it take 4 or 5 months like it did in 2020? Or will it take closer to 13 years like it did after 2000? And that's the real question. That's what I mean by a bear market is about time, not about price. Yeah, it'll make a new high. If you're 65 or 70 years old, your risk is that it takes another 13 years for it to make a new all-time high because you don't have that kind of life expectancy. If you're 35 years old, you might say, you know what? I wouldn't mind a 13-year chance to dollar cost average at lower prices because I'm going to make a lot of money over the next 13 years with more and more paychecks and just keep plowing more and more in at these prices. So keep in mind that, you know, in bond market parlance, it's your duration. How much time do you have left? And that's the risk you have to take with the stock market. So let me give you an example of what I'm talking about. I was listening to a podcast like a week after Liberation Day when the stock market really tanked and fell almost 20%. And there was a woman on the podcast. She said she was 72 years old. She said that she was within a month of her mandatory withdrawal out of her 401k and IRA, and that she was all loaded up in Mag 7 stocks, and she saw a third of her net worth disappear in a month. Now, if you're a month away from your withdrawal, you should be in treasury bills. You've already made your money. Your biggest concern at that point is going to be not lose it. You can't magically fix that problem in the last month. So you've got to kind of think about, you know, if you're 32 years old, that's perfectly acceptable, or 42. But when you start getting closer to those withdrawal dates, you got to start thinking about, you've already done what you're going to do. You just don't want to, you don't want to lose it at that point. And so that's why it's very important to keep in mind, bear market is, I think, time, not necessarily price. Now, yeah, it'll go down. It might go down more. But the real question everybody wants to know is, when's it going to make a new all-time high? And, if it's 13 years, that means one thing for the 70-year-old. If it's 5 months, that means another thing for the 70-year-old.
Well, I know. And then, the average bear market's 9 months, but that distribution is wide. Sometimes,
Right.
like you say, 13 years, and sometimes it's 5 or 6 weeks. But on that same note, you had some really good graphs over the past this year on the retail investor. And basically, I think what you're putting in those, the retail investor is still in it.
Not only is the retail investor still in it, but the retail investor has become more dominant and the retail investor has changed a lot. So what we saw the retail investor do in April when the market took its dive was they bought. They bought and they bought and they bought because they've been trained for decades to buy the dip. In fact, it's a term on Wall Street, buy the dip. And that's what everybody does because it's always worked out in the past. And so we've seen them do that. Now, that didn't, that again, is that a bad strategy? If you're 32 or 42, it might not be. If you just keep at it, if you're 72 and this takes a long time, that could be a different story. The second thing that we've seen is that the retail investor has changed quite a bit in the last 5 years. So when we think retail investor, we think kind of set it and forget it, put your money into a professional manager, a wealth fund manager, an ETF, a mutual fund, and just sit there with it over the long term. That's typically the over 50 crowd is who's doing that. But there's a newer crowd of younger investors that are buying zero DTE options, which are options that there's every day there's options on stocks in the stock market that expire at the close that day. 0 for 0 days to expiration options. Crypto, meme stocks, and they've turned the stock market into a bit of a gambling casino is what they're doing. They've become a fairly potent force in the market. Now, I'm not a biggest fan of that because I think that, like I said, it's more gambling than it is investing. And there's going to be problems along the way because, as we all know, with any kind of gambling, most of the time, whether you're talking about Vegas or sports gambling or this kind of what they call the bro bid is what its nickname is right now, usually the gamblers lose. And they lose usually a lot. And I don't think they're going to be any different in the stock market than they are whether or not you're betting on NFL or if you're at the casino at the craps table.
And they're still buying, if you look at those big 7 stocks, they're still buying the triple leverage, the double leverage. I mean, a lot of volume too, 300 million shares, that kind of stuff. It's great.
Yeah, it's been incredible. As a matter of fact, if you look at the Chicago Board Options Exchange, it has over 2,000 stocks listed that you could trade options on. 70% of their volume is either the S&P or the 7 stocks. Eight symbols are 70% of their volume. Yeah. The other 30% is 2,000 symbols.
Yeah. So let me wrap up by asking you this one last question, and that is, if you had a whole group of investors out here, Jim, what would be your parting advice to them, just in general, probably how they should be reacting right now?
Understand, let me go back to the beginning. Understand that we were at an unsustainable period, that we had too much debt, too much government, too big a deficits. That had to change. We can't go back to that. We are in a period now of a realignment. Now, if we do it right, it will be fine. It'll be bumpy along the way and it'll turn out to be fine. If we do it wrong, it could be kind of messy. I'm going to be optimistic for the following reason. Most of the time when a country or a company gets into that kind of unsustainable period, they kind of just go hope and pray until basically the market blows up on them. The famous line from Ernest Hemingway's book, How Does One Go Bankrupt Slowly Then Suddenly? And they just, the suddenly phase comes on it and forces it on them. We're doing this voluntarily, and I think that's good because we're setting the terms of how we can do this realignment. Now, maybe the first cut at this is a little bit too chaotic and it might not be proper with what we're doing with tariffs. Don't worry, we can change it. It's not being forced on us that whether you like it or not, this is the way it's going to be. So sit down and eat your green beans, even though you hate them, because it's time's up. So I'm optimistic that we'll get this right over time. It'll be a bit bumpy, But what I would say to people is, look at the debt, look at the deficit, look at the size of government and everything else. We could not continue doing what we were doing. And so this change was inevitable.
Well, I want to thank you, and we're going to have everything up there about your research and your site and Twitter and everything that you do. And I would encourage people to look at your research. I don't know where you get all the graphs, but they're really good, and they're all.
Thank you.
And I think you do one of the best jobs on Wall Street, and I want to thank you. But Jim, thank you for being with us, and hopefully we'll see you again next year.
Thank you very much. Enjoyed the conversation.
All right, thanks. Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.